Hey everybody, welcome back to the weekly analysis, and I just want to take this moment at the beginning, to remind you to hit the like button and subscribe to this channel if you find the content helpful. And I'd also like to point you to my Twitter account, or I guess X, and you can find me at Mr. J. Thomason. I post there quite a bit, as well as you can subscribe to my newsletter on Substack at befinanciallyfree.substack.com, and you can get the first half of my newsletter absolutely free, and then the second half requires a paid subscription. So you can find the links both to my Twitter account and to my Substack in the description of the video below. And so the question that I'm asking this week is this time to buy the dip? Are we supposed to buy this dip, or is this the beginning of a crash or some sort of deeper correction? And so I've got a series of things I want to talk about, point out today, starting out with equity markets. I'll start with the levels and kind of see where things are at from here, where I would be looking at for technical breakdowns, or if there's technical breakdowns already in process, as well as through my tide indicator, which I share about in my newsletter as well. But looking first at the S&P 500, we got a break below the tide line, and you actually can see when you zoom in that the tide line has closed red for the week. So in the near term, what that signals is more bearish momentum. But I do want to point out that the tide is bullish, which is where, again, the colored line is above the faded gray line. That's what I call the control line. And so a few things to point out on that. I wanted to point that out, as well as to point out that the prevailing trend this is the trend line I'm watching. So there's still plenty of room potentially for the S&P to fall. It's actually 4,200 to be the level to fall to get a test on this trend line. And actually, I think right now, now that I'm looking at this, I want to see if there's any market symmetry here. Not really. Maybe a little bit. Maybe that's some of the symmetry. That would be a fake breakout if this was what the market was expecting. It could also be that, which fits as well. But obviously, right now, the most important part is the lower trend line. If we're going off of the tide, typically, going back to earlier bull markets, when the tide is, maybe I won't even say a bull market. I'll just say when the tide is bullish. Usually when price falls in between the tide and control line, or if it can fall below the control line even, then those are usually great times to buy. You can kind of see along here these different sections where that took place. And then of course, once the tide goes bearish, which is when the colored line falls below the gray line, then obviously price crossing above, those are places to sell. Or to either go short or to sell any counter trend rallies that have taken place. So that's another level I'm calling out, because I think that there's a lot of fear right now in the markets. I'll get to that shortly, but right now in the S&P, this is, as far as tide goes, this is actually a really good spot usually to buy in a occasion that doesn't happen very often, at least when you're in bullish tide. Now, obviously, there is always a possibility. Nothing is ever foolproof. There's always a possibility that this is going to break down and be much steeper of a fall. But on a probabilities basis, during bullish tide, this is usually the place to buy. So what I will be watching for is an invalidation of the 4,300 level, and then an invalidation of the 4,200 to 4,250 level on the S&P 500. If those things happen over the next few weeks, then obviously we've got worse things happening. But what the beauty is, something that I want to point out for you guys too, is the value in subscribing to my newsletter and just following me closely, whether it be on Twitter or otherwise, is obviously I have this bottom-up overlay that I typically watch the markets through, and you can see that it colors the candles green and red and yellow. And Obviously, the candles went green on the 10th last week, and I've been out of the, or this overlay is out of the market ever since, and so that's obviously a good thing because 50% of this move from the top on the S&P has basically been avoided by the overlay. So what I would also be watching for is this overlay to get a yellow neutral signal. That would be the sign that that things are improving materially. So I want to be looking out for that. Take a look at the NASDAQ. And we've got on the NASDAQ, again, actually more than 50% of this drop has been during the bearish candles, the red candles. And so the overlay is doing its job to keep you out of the market during these collapses, as well as keeping you in the market for the rise, for most of the rise. I mean, if you go back in the market when the candle, when the candle closes on this yellow candle, and then you get out at the close of the first red candle, and we're talking about 25% gain that you were able to take advantage of in the markets, and that's you can't beat that. There's nothing better than a systematic process to know when you should be in the market and when you should be out of the market. On the NASDAQ, as far as trend lines go, the trend line I used to have was here because there were a couple of touches here as well as in April and early May. But on the breakdown, you see it broke down actually on Wednesday. On the breakdown, I adjusted the trend line down because I want to see if the trend line will match up with the zone that I called out both in my newsletter and actually in my video last week and over the recent times that I've posted, looking for a correction in the NASDAQ. And again, because just like the S&P 500, the tide line and the control line are great places to watch. This zone is a great place usually to buy when the tide is bullish. This is the first time since the tide cross. I mean, I'm not really going to count that March period. That was very weird. But this is the first time since that initial cross that we're getting a test of the tide line and of the control line. So that's something I want to watch out for. And the yellow box there on the screen is where I indicated it's the zone. It's about I want to say, what is it, a 400 point zone on the NASDAQ, where I pointed out previously that might be a place where bears get caught off-footed, and I'll get to that in just a little bit. Levels on the Russell. The Russell closed a little bit better, closed up today versus the rest of the indices, but it is actually right in the middle of the zone, kind of at the place that I was watching over the last couple of weeks. It is in a deep, what I would consider to be a deep value zone according to the tide indicator, but I'm not sure that I give that as much weight in this instance, because the market has been sideways all basically since last year, last summer, the end of last summer. So I just want to be aware that in sideways markets, a lot of these trending indicators are not going to be as reliable, and so price could stabilize here and then bounce back up, but I think it's more likely that at least on the Russell we could see some downside, at least on a technical basis, but this was the level that I called out as the first test to see if price would indeed continue down to that lower trend line or not. So it'll be interesting to watch going into next week. You actually can see, if you kind of pull back, you can actually see what appears to be potentially a level of horizontal support. We got some resistance there. It became support and touched there. That would be another place that you could watch. Speaking of stocks, so with the stock market in mind, one thing I was watching, and I have been watching, is these two charts that I have of you can get on TradingView of this S&P 500 stocks above the 200-day moving average, and then the other chart that I look at, which is stocks above their 50-day moving average. And more or less for the last year, we've been kind of going back and forth between these extremes. having gone down below the 10 level back at the June lows of 22, and then getting up above 90 during the August highs of 22, back below the 10 level in late September and early October of 22, back above at the end of November before the decline into December. We got down pretty low right around the time of the Silicon Valley Bank collapse and the banking crisis. We got almost to the top of that near the end of July, right around the time where the markets peaked. And on the S&P 500, stocks above the 50-day moving average, I'm actually looking for potentially, we'll see, I'm not sure if this will happen, but I'm looking for this to come down to or below, maybe just barely above this 10 level. Probably even the best thing to do would be to watch for it to hit somewhere between the 20 and the 10. I think that would be a good signal that would be a buyable bottom. That's not the only thing I'm going to watch to see if this is the bottom or not, or if this is a buyable dip or not, or if this is going into a crash or not. To go along with that, going back to the stocks above the 200-day moving average, what I was watching for today is there's been some pretty steep momentum to the downside ever since, again, the same place, the top around the 25th, 26th, 24th of July. What I was watching for today was, depending on where markets went, would this pop below the 50 line? Because when the percentage of stocks below their 200-day moving average goes below the 50 line, that's usually a pretty significant risk-off signal, and that's been a pretty reliable signal. Like even if you go back to the 2018 Q4 bear market, early October, basically right as the market began to decline, you saw that number, or you saw the number of stocks above their 200-day moving average dip below that 50 line. So this one is not confirming what I would expect to see if we were in the middle of a crash. So if both of these were precipitously declining, if this had gotten below the 50 line, then I might have a little bit of a different tune, but that's not the case, and so that's one strike against the thesis that this is going to be a big crash or like bear market correction sort of scenario. Let's take a look at the since we're on equities again, let's take a look at the VIX. Volatility has picked up. Volatility is at its highest close to a week since going back to, let's see, our highest weekly close was back in the end of May. And so this is a pretty big deal. We're up pretty substantially. But in the grand scheme of things, I mean, the overall trend is still down. What I would be watching for is if we can get to a point where this, even on the VIX is a little bit different, but even if we can get the VIX tide line to curl up substantially and maybe potentially cross, sometimes the upside, I should say, cross on the tide line is usually a signal, or it can be a signal that there's a near-term bottom. So I don't want to just say that, the tide line is when you should go long the VIX or you should go short equities. I am looking at this as more of a directional indicator, not so much of a this is the exact spot to buy or to sell equities or whatever. Taking a look at the dollar, let's go to the dollar and fixed income. On the dollar, kind of sideways today, but I'm really watching this closely. If we can get a bullish cross on the tide here, that's going to not be a good thing for asset markets. This is an interesting spot because because you can see the tide line is really starting to curl up. But this is also typically, you can see right here it happened and also right here it happened, that these are really good spots usually to sell. And so that'll be interesting to watch the trajectory of the dollar. We'll have to look for clues outside of just the technical analysis in order to kind of see where to go from here. Another thing that a lot of people that I've seen have been pointing out is the trend line here on the dollar. So dollar is into resistance, so maybe an upside break of this trend line will mean it will mean that we are going to get that tide cross and a broader correction in risk assets. But if this continues to be rejected and actually begins to collapse into next week, then I think that that's going to be beneficial for equities and generally risk assets. Going here to the 10-year Treasury yield, we popped up to 4.32. So we didn't quite we didn't quite get up to, like, as far as the wick, the intraday wicks, we didn't quite get up to the high that we got to back in October of 2022, but we did yesterday close at the highest level. I can't even think of how far back it was. Yeah, it's been a while. We closed at our highest level in a really, really, really long time on the 10-year. And you can see here the tide is curling up really, really sharply. It's extremely bullish. Without checking out some of my other charts, without taking the time to pull them up, I can't really tell at this point if we're looking at potentially what could be a blow-off top. That is something that I'm going to be watching for. I'll be looking for divergences on some of the underlying indicators that I watch. So we'll see on that. The TLT, I wanted to pull up this chart of the TLT because we are at a spot where if you think that the lows on TLT are in, then this is a good spot to jump in and take a long, just a kind of maybe a YOLO long. Of course, we are in bearish tide still, and this is what's amazing. A lot of people back here in October and on these lows in December and in February, and even into March when we had the SVB collapse, people buying bonds, talking about recession coming, and it just hasn't materialized, and so there's been no reason to own bonds with inflation still relatively high and growth still strong. And all this time, like if I turn off the tide line for just a moment, you can see like these trend lines. I basically put this trend line in once we hit this little high in February, and then I duplicated the trend line, and it works really, really well. And price stayed there, and then eventually broke down finally. Like that's a freaking good channel, honestly. So I'll pat myself on the back for that one. The breakdown was really the coming of the breakdown was really clear. So let me get this tide line back on, and just across this whole period of time, like not only was price not breaking the upper trend line, but the tide line was never crossed. As soon as the tide line got past this area back in May and then started to open again or diverge further from the control line, I was pretty convinced that TLT was going to go back down to the bottom again. Started posting about it in my newsletter a few weeks back, just because I wanted people to be aware that this breakdown would get really ugly, and it has. Let's take a look at gold. I'm going to scream about this one. If we get a tide cross here, like I'm going to take victory laps, because back here when the price of gold, let's see here, it was it was back in April, right around here, in this area, when the price of gold is above $2,000 and everyone and their mom's talking about all-time highs. I said all-time highs in gold are going to be a next year story, not a 2023 story, and got pushed back and all that, and ever since then, gold had another opportunity to come up. If you're paying attention, this is a lower high, and we've made a lower low now. Price is trending down. Maybe what I'll be watching is, is something like this. Maybe we could be looking at, a wedge. Maybe it's a wedge. It could also be a descending channel or a downsloping channel. Yeah, it could be something like that. So I'll watch both of those. But in any case, gold is heading further down, and it wouldn't surprise me at all if, a month from now we're looking at gold close to 1,800, maybe even below. If the tide crosses below, then I'm gonna say it probably will get down to about 1,800 before it's all said and done, and maybe even lower. But anyway, I think gold will make all-time highs, but not until on the other side of a recession or on the other side of some kind of credit event, which more and more people are pricing out. I mean, this isn't that hard. This is part of the reason why this is called matrix markets, because because when you see the matrix, like when you can finally see the matrix, it all makes sense. I mean, without any sort of fear in the markets, without any panic, without geopolitical panic, or without like some kind of crisis to drive investors into gold. And as long as growth remains strong, there's no reason to expect that gold is going to go up over time. And if there's a credit event, like maybe on the other side of that, gold will go up, but gold is not going to be able to withstand that. I mean, go back to the liquidity crisis back in March 2020, gold dropped. It dropped like 20% or something like that. So, or 15 or something. I can't remember exactly the number. But point being, don't expect gold to go up above its all-time high until next year. Crude oil, we got the tide cross. I wrote about this in my newsletter last week. And I personally have been watching to see if price would come back and test this area. We kind of got a test of like the upper end of that. I was actually looking honestly for 78, between 78 and 76 is the area that I was looking at. Didn't quite get there yet, so we'll see what happens next week. But as price comes down, as long as no recession continues to materialize, I mean, like think about what this is, ever since, people started calling for a recession back in like the summer of 22, and people have assumed that because of recession, there's going to be no oil demand, but the U.S. economy has remained resilient. You have the Biden administration releasing SPR oil all throughout, and a lot of that pressure is gone now, and the Saudis and OPEC Plus are trying to keep prices elevated, and then the strength in the economy hasn't gone away, and so it's only a matter of time, in my opinion. I think like I said, I think we come down. We might dip maybe even a little bit lower than I expect, but I'm actually expecting this to head up to maybe into the 90s, maybe into the mid 90s, before any other material downside comes into play. So that's kind of my view on crude. And then lastly, we'll touch on Bitcoin before I go look at some other things that I wanted to show to wrap up. Bitcoin had a giant dump yesterday. There was a couple of things. There was some news that Elon Musk and SpaceX sold their holdings of Bitcoin. So that was a big deal. And then I think there was some news also about the SEC and the Ether ETF, the futures ETF. And then there was a massive amount of long liquidations that took place here. And so this is probably, honestly, this could be the low of this move. It looks to be at a good level of support around 25,000. You can see we had resistance there. It was, in a resistance level back in August 22. It was the support for, I think this was the Luna low back in May 22. Support in June earlier this year. So this may be a pretty durable spot to take a poke. And I will say this, with Bitcoin, when the tide is bullish, let me go to the last time. I think I showed this last week, but when the tide is bullish, it's trying to find a place where the price goes below tide. It doesn't really happen that much. In fact, as I've looked more, price going below tide, below the tide and control line when tide is bullish actually is usually often a trend shift, except the only exception that I've found to that so far during bullish tide is September of 2021 on the double wave into the peak, the November 21 peak. So that's something I'm analyzing still. I'm trying to back test and see what the tide signals would be there. And how accurate they are, how powerful they are. So that's kind of where things are at, and I know it's taken me a little bit to get to this part, but one of the things I wanted to take a look at now is this question, are these levels that I've been watching, are these reliable levels for a buyable dip, or are we going to see some downside? And the things that I wanted to take a look at really briefly first was the positioning data. And CFTC positioning data has been updated now as of today. We're still net short on the S&P. We're much more net short than we were previously on the Russell, and then the Nasdaq, we're actually net long, going from net short to net long, and so I think that's pretty interesting. If we look at some of these things on a percentile basis, the S&P, Nasdaq, and Russell are in their 30s-ish percentile positioning as far as futures and options go, and that's it's not the lowest quartile, but it's low enough to consider that there's not any problems with over positioning in equities. Versus the other side, if you look at the long VIX, look at the 71%, 71st percentile on the long VIX. To me, that's an indication that there's, and I wish I had the previous reading on this. I should probably update this chart to include the previous reading, because the previous reading was not even remotely close to at this level. And so I think that that's something that I want to call out. And I need to erase this, excuse me. And so I think that there's a pretty good chance that that some of these VIX positions are going to have to unwind, and that will probably provide some fuel to the upside for equities. And then the other thing I wanted to look at is the investor sentiment. This is pretty interesting. So let me go to this one. What you're seeing on this chart is the percentile ranking of bullish, neutral, bearish, and sentiment, and then the spread between the two. And it's not so much the percentile rank itself; it's the change from last week to this week. We went from 77th percentile bullish sentiment to only the 45th percentile, and meanwhile, the neutral and bearish percentile rankings jumped by about 20 percentage points as far as their ranking goes. And then the spread went from 76% to 47%. That's, to me, pretty telling that the price action, over the last, I think the CFTC Commitment of Traders report is done by Tuesday so that it can be published Friday. So it'll be interesting to see too, like what the this is CFTC. The sentiment data, CFTC. Sorry, I was a little confused there. Forgive me for that mix-up. It'll be interesting to see what next week's sentiment survey will be, because there is, just like CFTC data, that's kind of what I was trying to get at. There is a little bit of a delay. There's a little bit of a lag, I should say. So this will be really interesting. Sentiment is not everything. It should not be weighed as heavily as positioning. However, this sort of a change in sentiment is pretty telling. And so I kind of feel like, and if you look at it on the time series, the bull bear spread dropped precipitously back to kind of the median range between the two standard deviations. And so, to me, this could be the sign of, we could see further downside, but the amount of panic that I'm seeing just on Twitter, that to me seems to be backed up by the fact that, the VIX has now jumped to the 71st percentile as far as positioning goes, and that the bull bear spread and the bullish sentiment has dropped so precipitously, suggests to me that, kind of something I've been looking at in my newsletter recently, which is to say that that bears are going to get too excited here. I've been expecting this correction for, I want to say a month or two. In fact, I believe it was exactly a month ago that I said the correction would begin in the next 2 weeks, and that was largely correct. But I've been expecting a correction for some time, but I have been saying the entire time that the correction would not be the last correction. That was kind of my thesis on this. And so I think a lot of this data is supporting this idea that on the first major breakdowns and the first major pullbacks of 2023, since the SVB crisis, are creating enough fear in the markets that I think the bears are going to over position to the downside again, expecting to get a wash down. and then they're just going to get squeezed again. And so I don't think, I mean, I think the data supports the view along with, the technical analysis that I'm doing and my indicators suggesting that this is actually a buyable dip. Now I'm going to let the systematic process play out, and I'm going to allow, prices to dictate, or the colors on these candles to dictate when to start positioning back in. But I do think that we're going to see more upside before we get the actual credit cycle downturn recession that I am anticipating. So that's it for today. Thank you for listening. Thank you for tuning in. I hope that this was something that was worth your while. Don't forget to like and subscribe to the channel, and I'll see you guys next time.